For the first time in almost a decade, 3 members of the Federal Reserve dissented with the majority and Chairman Ben Bernanke's vote on policy. As the pressure grows on the Fed to save the recovery, the central bank may be more divided than ever. And our next guest isn't encouraged. Joining us now, Jeffrey Davis, Chief Investment Officer at Lee Munder Capital. It's a $5 billion global equity fund. We also want to welcome back Doug Cliggott, U.S. equity strategist at Credit Suisse. Jeff, a lot of the research notes overnight that I read suggest that Ben Bernanke is actually the hero here compared to the shenanigans we've been used to on Capitol Hill.
Well, I think that's a stretch. I think they were, you're encouraged by the fact that they really can't do anything anymore. I think some of the problems that have occurred in our economy is by an overactive Fed rather than a Fed that should be just staying the course. They've their tool bag's running shallow right now. So I think by extending out the period of which they're going to keep interest rates low, that's kind of a non-event for an announcement yesterday. But the market reacted well, so I think that's what they're trying to do.
Jeff, what is the alternative, though? The alternative would have been, I guess there are a couple of other things the Fed could have done. It could have reduced the rate that it pays in interest on bank reserves at the Fed. But the real alternative, it would seem, was QE3. The Fed dropped hints that maybe QE3 could at some point appear in the future. It didn't yesterday. Would you rather have seen QE3, or would you rather the Fed have done nothing at all?
No, I'm kind of in the second camp. Don't just do something, stand there is sort of our mantra right now. And that's because they've probably been too active and the market's reacting too much to what the Federal Reserve is doing and probably not enough on the underlying fundamentals of the market. So, you're a little bit of addicted to the Fed action. Right now, they're as accommodating as they should be. QE2 would be overstepping the bounds. A lot of other things have to happen within the housing market right now and within the financial reserve system, within the financial system of the banks to stimulate the economy more than what the Fed can do at this point.
Doug, Jeff says we just need patience. It seems like it's something that nobody has. Can the equity markets tolerate that?
Well, it really depends.
Patience on the Fed side. I'm sorry. Sorry, go ahead, Doug.
No. I think it depends on I think it depends on how earnings turn out, Sarah. If trailing earnings right now are about $90 a share. Over the long haul, it's really the trend in earnings that dictates where equity prices go. Earnings continue to grow. Our concern is with what we're seeing with all these weakness in leading indicators is that earnings next year might actually end up below where they are right now. That's not our current forecast. We're at a flat earnings picture for next year, but the risk is clearly, more to the downside. Things have deteriorated.
Here's a question for both of you, Jeff and Doug. What is the relationship between the zero interest rate policy and all of the quantitative easing we've seen and those corporate earnings? In other words, when the point comes that the Fed starts to tighten, whenever it's going to be 2013 now or later, but maybe even sooner than that, make some changes in the mix of quantitative easing, how's that going to affect the corporate earnings picture?
Well,
Jeff,
I'll pick that one up. I feel like the analogy that's suitable right now is when you flood an engine. It probably doesn't happen much these days, but there's too much gas being applied, and really the engine isn't catching. And the problem isn't the accelerator. The problem's with the engine itself. So I think the quantitative easing is probably too much. They're throwing too much gasoline into the engine right now. And really, what has to catch is underlying. I think the problem is right in the housing sector, which is dragging down the rest of the economy. And once investors, homeowners, renters get sort of back on their feet after a horrific 2008 that still lingers with us, I think when that happens, you'll see the economy rev up again.
Doug, last word to you.
Yeah, I think that the driver of this profit cycle is fiscal policy, Eric. I think the blowout in the budget deficit's one of the things that have given us this dramatic improvement in margins. So our view is when we start to really tighten fiscal policy, that's going to have a real negative impact on earnings.
All right, we want to give a special thanks to Jeffrey Davis, CIO of Lee Munder Capital Group, and to Doug Cliggott, U.S. equity strategist at Credit Suisse.